So you want to set up an offshore company and pay less tax. That's great. But if you don't structure it right, you might unknowingly still owe your home country a tax bill. In this video, I'm going to show you the 3 pieces of the offshore puzzle that determine whether your offshore setup actually works or whether it's just expensive paperwork. If you don't know me, I'm Elliot. I'm the founder of the UK and UAE-based tax and accounting firm Make Accounting Simple. And on this channel, let's talk about tax. We break down complex tax topics for entrepreneurs and online business owners. Please note that nothing in this video should be taken as specific personal, tax, legal, or financial advice. This video is just for educational purposes only. Today, I'm going to walk you through the 3 critical components of any offshore setup: where your company is incorporated, where you live and are taxed, and where the company is actually run from. Let's break them down. First, let's look at where your company is incorporated. Perhaps you've picked a jurisdiction. Maybe it's the UAE, BVI, Cayman, Singapore, Panama, Cyprus, or Malta. All of these offer low or no taxes and cater to entrepreneurs and global businesses. You go ahead and set up the company, you get a local bank account, you charge your clients, you pay your contractors. But here's the mistake. Just incorporating in a tax-friendly country does not automatically mean your company is a tax resident there. Why? Because of a concept called effective place of management and control. It means, where are the key decisions being made? Where is the company actually run from? If you set up a company in Dubai but keep living in the UK and you're the one running the show, that company is likely going to have a corporate tax liability in the UK, not Dubai. And that defeats the whole point. This is the same if you set up in another low or no tax country instead of Dubai, and we're living in another high tax country instead of the UK. The next component we'll look at is number 2, personal tax residency. Most countries follow a residency-based taxation model. So if you're living in Australia, the UK, Canada, or most of Europe, then you're going to be a tax resident there based on the amount of time you spend there and your ties to that country, and you'll need to pay tax on your worldwide income. If you want the full benefit of an offshore setup, you usually need to change where you're living and your personal tax residency and not just set up an offshore company. This is to ensure that when you pay yourself from your company, you don't need to pay high amounts of personal tax on the salary and dividends you receive. Otherwise, both you and your business might still be tied to your original tax jurisdiction and you're effectively back where you started, but with more paperwork, higher running costs, and no actual tax savings. The third component is where the company is effectively managed from. Now, we covered this briefly in relation to where the company is incorporated because all 3 of these things are very interconnected. But this is the trickiest part and often the most misunderstood. Even if your company is incorporated offshore and you've moved personally, your setup only works if the company is also effectively managed from the same place. Most online businesses, e-com, agencies, coaching, info products, software, or influencers, the founder is the business. If you're making the decisions, creating the products, hiring the people, then wherever you are becomes the center of control. That means if you live in Australia and run your UAE company from there, your company will qualify as a tax resident of Australia, not the UAE, unless you structure things differently. Let's look at how to make it work with some examples. So example 1, you live in the UK. You set up a company over here in Dubai. You keep living in the UK and you run everything from there. You think you're avoiding the 19 to 25% corporation tax and benefiting from Dubai's 0 to 9% corporate tax. But actually the UAE company would be considered a tax resident of the UK and need to pay 19 to 25% corporate tax under the effective management and control principle. And you've really gained nothing. Example 2, you live full-time in Bali. Your business partner lives full-time in the UK. You set up a company in Dubai. Neither of you actually operate from the UAE besides going once every 6 months just to maintain your residency. Now, this Dubai company doesn't have sufficient presence in the UAE to be seen as effectively managed and controlled from there. As there are 2 partners, the place of effective management and control isn't just in one place. In this scenario, it's likely that that UAE company has a permanent establishment in both Indonesia and the UK, and these countries may each have a right to tax a proportion of your profits. Plus, you'd be personal tax residents in Bali and the UK respectively, meaning that you'd need to pay personal tax in those countries on your worldwide income. So paying money from your Dubai company to your Dubai bank account would still technically be taxed in the UK and Indonesia. Example 3. You set up in Dubai. You hire a local general manager or director based in the UAE to make key decisions. You live full-time in Bali and your business partner lives full-time in the UK, but neither of you are responsible for the key day-to-day decisions of the company. That's the responsibility of the UAE general manager. Instead, You receive no salary, just passive dividends as shareholders. You go to the UAE a few times throughout the year to maintain your residence visa and have board meetings in the UAE. In this example, you've now got sufficient substance in the UAE thanks to your general manager and your board meetings. There's almost no risk of the UK or Indonesia being able to tax your company because you're not creating a permanent establishment there by doing any work. And so the company will pay the 0 to 9% corporate tax in Dubai. However, you'll still be personal tax residents in Bali in the UK, and you'll need to pay personal tax on the foreign dividends you receive from the UAE company. Now, that's the case even if they're paid into bank accounts in Dubai. But because the UK and Indonesia tax you on your worldwide income, you'll still need to pay taxes there. Now, this is a lot better than paying taxes on everything, but it's still not as good as the both of you relocating to Dubai as well. So let's quickly recap on those 3 points to get right. Where is the company incorporated? Where do you live and pay tax? Where is the company really managed from? If you're optimizing for tax, you need to make sure that the company is incorporated in a low or no tax jurisdiction. If you want to pay low or no tax on your personal income, you need to ensure that your personal residency is in another low or no tax country. And if the company is set up in a low tax jurisdiction and you're living somewhere else, make sure that the company has sufficient presence in the country of its incorporation to be taxed there. For example, a local manager or director, and that you're not creating tax issues for the company by managing it from where you live. If you make sure all of these 3 components are aligned, you'll have optimized your personal and corporate tax for your offshore setup. If you don't, you could be exposed to double taxation, compliance issues, penalties, fines, and a whole world of administrative pain. Offshore setups can be powerful, but only when done right. Many people are sold an expensive offshore setup without considering points 2 and 3. Make sure that isn't you. If you found this helpful, please subscribe to the channel and drop a comment if there's a specific topic you want me to break down next. In the next video, we're breaking down how to legally leave your current tax residency without raising red flags. If you're a UK or UAE business owner, my firm, Make Accounting Simple, can support you directly. Links are in the description to work with us. And if you want to work one-on-one with me to review or plan your setup, you'll find a consultation link below as well. Also, as a reminder, this video and channel breaks down tax topics to make them easy to understand, but it is not personal tax advice, and these videos are for educational purposes only. Everyone's situation is different, so please speak with a qualified professional specifically about your situation before making decisions about your taxes. Thanks for watching, and I'll see you in the next video where we'll be talking more about tax.